First off, the timing matters. If this video had been made in 2015, the answers would look very, very different. But in 2025, the rules are changing, and if you don't adapt, you'll see your yield fall or your risk blow up. The hybrid phase out by APRA. One of the biggest structural shifts happening right now in Australia is that bank hybrids, especially additional Tier 1, AT1, capital instruments, are being phased out as part of regulatory changes. Let me break that down. In December 2024, APRA, Australia's prudential regulator, formally announced that AT1 instruments will no longer be acceptable as bank capital going forward. The transition timeline begins in 2027, and by 2032 these instruments must be replaced. That means many existing hybrid instruments will get called earlier, or converted, or devalued as liquidity dries up. Because these hybrids were a go-to source of yield for many retail investors, thanks also to franking credits attached, this creates a huge yield vacuum that needs to be filled. In simple terms, the familiar buy a bank hybrid, collect 5 to 7% yield, enjoy franking credits model is being dismantled. That doesn't mean yield goes away, it means you'll have to be smarter and more diversified to get it. Yield compression, rate cycles, and macro pressures. Another factor, interest rates and inflation. The Reserve Bank of Australia's moves on rates have been volatile. If inflation comes down, rates might be cut, which can push bond yields or credit yields lower. On the flip side, if inflation surprises on the upside, yield opportunities may persist, but credit risk gets harder to manage. You also have global forces, USD interest rates, global credit spreads, supply chain stresses, bleeding into Australian credit markets. So you need flexibility. You don't want to be locked into rigid income instruments that give you low yields if rates decline or get stuck if spreads tighten. The income gap for investors. Many Australians, retirees, part-timers, FIRE aspirants are desperate for cash flow that outpaces inflation. Term deposits are offering paltry returns. Dividend yields from Aussie equities are okay, but concentration risk and volatility are real. The goal of a hybrid income portfolio is to bridge that gap, to generate sustainable income that has some capital buffer, diversification, and a path to growth or at least protection. That sets the soil. Next, we need to define clearly what we mean by hybrid income portfolio, especially in the Australian context, and unpack what sources we should include. When people hear the word hybrid, they usually think about bank hybrids, those ASX-listed securities that sit somewhere between a bond and a share. But that's actually a narrow definition. When I say hybrid income portfolio, I'm talking about something broader, a diversified income ecosystem that combines fixed income instruments, like bonds, credit funds, or term deposits, equity income instruments, dividend-paying stocks, listed investment companies, ETFs, real assets and alternatives, infrastructure, REITs, private credit, even tokenized assets in some cases. The idea is to capture steady yield from different sources, not rely on one type of security that could get regulated out of existence. Let's make this practical. The 3 pillars of hybrid income. Key Cap 1 defensive income, low risk. This is your foundation, predictable yield, high liquidity, low volatility. Government and investment-grade corporate bonds. Cash and term deposits. Bond ETFs like VAF, Vanguard Australian Fixed Interest ETF, or IAF, iShares Core Composite Bond ETF. High-yield savings accounts, for instance, Macquarie Bank Savings Account, ING, or UBank often lead rates in Australia. This layer protects your capital and provides liquidity. Target return, around 4 to 6% PA, depending on rate conditions. Key Cap 2 Core Hybrid E-Credit Income, medium risk. This is where you get better yield, but you take on measured risk. Listed bank hybrids, like ANZPF, CBAPT, etc. Corporate debt funds like Capstream, Ardea Real Outcome Fund, or Metrics Credit Partners MCP Master Income Trust, ASX, MXT. Floating rate note ETFs such as BetaShares QPON, Australian Bank Senior Floating Rate Bond ETF. Private credit or direct lending opportunities through funds like Australian Unity's Diversified Credit Fund or Qualitas Real Estate Income Fund, ASX-QI. This layer gives you your income engine. Yields here typically range 6 to 9% PA, sometimes higher with floating rate exposure. Key Cap 3 growth-linked income, higher risk, inflation hedge. This layer introduces inflation resilience and potential capital growth. Dividend-paying equities, like the Big Four banks, Telstra, Wesfarmers, Woolworths, or dividend ETFs such as VHY, Vanguard High Yield Australian Shares ETF. Real estate investment trusts, REITs, for example, Goodman Group, Charter Hall, or CQR for retail exposure. Infrastructure assets, through ETFs like IFRA, VanEck Global Infrastructure ETF, or direct unlisted funds like AMP Capital Core Infrastructure Fund. Alternative yield sources, peer-to-peer lending, tokenized income platforms, or yield-based managed portfolios. This is the inflation-protected sleeve. It grows over time and can offset purchasing power erosion. Target yield, 5 to 8% PA on average, but with more volatility. Why hybrid is the right word here? It's hybrid not because you're buying a specific ASX hybrid note, but because your portfolio blends different income streams. That hybridization smooths your returns. When equities fall, bonds or floating rate credit may hold up. When rates drop, your REITs or dividend stocks might rally. The ultimate goal? To generate a stable, inflation-beating income while protecting your downside and giving yourself optionality to rebalance as conditions change. This is the kind of mindset Stephan often talks about, the smart, led approach. Not all or nothing, but enough of everything to stay consistent. Section 3, Understanding Bank Hybrids, and What's Changing. Now let's zoom in for a second on the Australian bank hybrid market, because it's the most misunderstood corner of the income world. If you're holding hybrids or planning to, you need to understand what they are and how they're changing under APRA's upcoming capital reforms. What are bank hybrids? Bank hybrids are securities that have characteristics of both bonds and shares. They pay a floating rate distribution, usually BBSW plus a margin, are convertible to shares or can be written off if the issuing bank faces stress, sit below senior debt in the capital structure but above equity. For example, a CBA Pearls 13 ASX CBAF might pay BBSW plus 2.75%, fully franked. So if the 90-day bank bill rate is 4.3%, your gross yield could be 7% plus with franking. Sounds great, but here's the fine print. These instruments can be converted to equity if the bank's capital ratio falls below a certain trigger. That's what we call bail-in risk. It's rare but possible. The problem, APRA's new rules. In late 2024, APRA announced a phased removal of additional Tier 1, AT1, hybrids as eligible regulatory capital. The reason? Global regulators, including the ECB, want to avoid another Credit Suisse-style wipeout where AT1 investors got zeroed overnight. So, by 2032, banks will need to replace these hybrids with a new form of capital instrument, likely simpler, more transparent, but with lower yields. That's why many hybrids are expected to be called or redeemed early between 2025 to 2030. Liquidity could dry up as investors shift to alternatives. So yes, hybrids have served Aussie investors well for decades, but this chapter is closing. What it means for investors. If you're holding hybrids, it's not panic time. But it is pivot time. Expect fewer new issues over the next few years. Existing hybrids may rally slightly before being called, but long-term yields will normalize lower. You'll want to diversify your income base, start looking at floating rate credit ETFs, corporate debt, and private credit funds. That's where a hybrid income portfolio shines. You're not married to one product category. Next up, the second layer of your portfolio, corporate bonds and credit funds. Think of this section as the engine that keeps your income steady while maintaining relative safety. Why corporate credit matters? Corporate credit fills the middle ground between government bonds, super safe, low yield, and equities, risky, high volatility. Here, you're lending money to high-quality corporations, often at floating rates, and earning 6 to 8% in today's market. In Australia, you can access these in three main ways. Direct bonds, via brokers like FIIG Securities or Bond Exchange. Bond ETFs, such as IBND, iShares Global Corporate Bond ETF, or HBRD, BetaShares Active Australian Hybrids Fund. Managed credit funds, like Metrics Credit Partners, MXT, MOT, Perpetual Credit Income Trust, PCI, or Ardea Real Outcome Fund. For most investors, ETFs or managed funds are simpler because they're diversified and trade on the ASX. You don't need to buy $50,000 parcels of a single bond. Real examples. Let's look at three popular ones. MXT, Metrics Credit Partners Master Income Trust, targets returns of RBA cash rate plus 3.25%, so roughly 7 to 8% PA, paid monthly. HBRD, BetaShares Active Hybrid ETF, a blend of hybrids and subordinated debt. Returns track around 6 to 7% PA, with monthly income. Ardea Real Outcome Fund, managed, focused on relative value fixed income trades, aiming for smoother returns and lower volatility. These are the kinds of products that can replace the yield hole left by traditional hybrids. Risk snapshot. Corporate bonds are not risk-free. Watch for credit risk, issuer defaults or downgrades. Liquidity risk. Some funds suspend redemptions in stress markets. Duration risk, fixed-rate bonds can fall if rates rise sharply. Mitigation. Diversify across issuers and maturities, and use ETFs or actively managed funds with proven track records. When interest rates rise, income investors suddenly feel rich. When they fall, it feels like someone turned off the tap. That's why you want growth-linked income, sources of yield that can increase over time, linked to inflation or company earnings. It's like giving your income a built-in cost of living adjustment. Let's break this section into three major parts. Dividend-paying equities. Real estate income, REITs. Infrastructure and alternatives. Keycap 1 dividend-paying equities. Dividend-paying shares are the cornerstone of income investing in Australia, and for good reason. Australia's franking credit system makes dividends from Aussie companies far more tax-efficient than most other countries. Franked dividends effectively reduce or eliminate double taxation on company profits. For retirees or anyone in lower tax brackets, those credits can make your effective yield significantly higher. Popular dividend stocks in Australia. If you followed Stephan's investing logic, cash flow, not speculation, these fit that perfectly. Some of the most consistent Aussie dividend stocks include Commonwealth Bank, CBA, dividend yield tilde 4.5%, fully franked. Wesfarmers, Wes, retail, industrials, and chemicals exposure, stable, fully franked dividends. Telstra, TLS, dividend yield around 4%, reliable and fully franked. BHP Group, BHP, variable yield, often high when commodities are booming. Woolworths, WOW, consistent dividend pair with defensive cash flow. Transurban, TCL, toll road operator, semi-defensive, with inflation-linked cash flow. Dividend ETFs for passive income. If you prefer diversification over stock picking, go for dividend-focused ETFs. Examples. VHY, Vanguard Australian Shares High Yield ETF. Focuses on high-dividend Australian companies. IHD, iShares S&P ASX Dividend Opportunities ETF, tracks the top dividend pairs on the ASX. SYI SPDR MSCI Australia Select High Dividend Yield ETF, good balance between yield and diversification. RDV, Russell High Dividend Australian Shares ETF, weighted towards quality dividend sustainability. These ETFs yield around 5 to 6% PA, often fully franked, and distribute quarterly. How to think about dividend income in a hybrid portfolio. The goal isn't to chase the highest dividend yield, it's to build reliable income. A 7% yield from a company that cuts dividends every second year is worth less than a steady 4.5% with strong franking and growth potential. So, when building your hybrid income portfolio, keep equities at 20 to 35% depending on your risk tolerance. That's enough to provide inflation-beating growth without making your portfolio too volatile. Key Cap 2 Real Estate Income, REITs. Real estate has always been a natural income generator. You earn rent, and that rent tends to rise with inflation. That's why REITs, real estate investment trusts, are an essential piece of a hybrid income portfolio. In Australia, you can invest in REITs directly through the ASX or via ETFs. REITs distribute a large portion of their income, typically 90% of profits, which makes them powerful yield tools, though they're more volatile than bonds. Examples of Australian REITs: Goodman Group, GMG, Global Logistics and Industrial REIT, lower yield, 2%, but strong growth and inflation protection. Charter Hall Retail REIT, CQR, yields around 6 to 7%, focused on shopping centres anchored by supermarkets. Stockland, SGP, diversified REIT with exposure to residential, industrial, and retail. Dexus, DXS, focused on office and industrial properties, yield around 5.5%. These are great for exposure to real assets that generate cash flow regardless of stock market noise. REIT ETFs to consider. If you want to simplify exposure, SLF, SPDRS and PER ASX 200 listed property fund tracks major ASX listed REITs. VAP, Vanguard Australian Property Securities ETF, broad coverage, around 4 to 6% yield. DJIE, iShares Global REIT ETF, adds diversification across US and global property markets. The role of REITs in a hybrid portfolio. REITs are cyclical, yes, but they're valuable for diversification and inflation resilience. When you pair them with defensive income like bonds or credit, you get a smoother overall yield curve. A sensible allocation might be 10 to 15% of your total portfolio, depending on your comfort with property risk. Key Cap 3 Infrastructure and Alternatives. Here's where things get interesting. Infrastructure, private credit, and alternatives are becoming the new face of income investing in Australia. Infrastructure. Infrastructure is unique because its revenues often have direct inflation linkage. Tolls, utilities, airports, renewable energy projects, they all earn income tied to CPI or usage. You can access infrastructure through IFRA, VanEck Global Infrastructure ETF, exposure to global infrastructure operators like utilities, toll roads, and energy pipelines. RINC, BetaShares Legg Mason Real Income Fund ETF, focuses on Australian real assets with inflation-linked cash flow. Unlisted funds like AMP Capital Core Infrastructure Fund or Colonial First State Infrastructure Income Fund, long-term stable income vehicles. Infrastructure tends to yield 4 to 6% PA, often with low correlation to traditional equities. Private credit and alternative yield. Private credit is booming in Australia. With banks tightening lending, non-bank lenders are stepping in, and they're paying investors to fund these loans. Funds like Metrics Credit Partners, MOT, MXT, Qualitas, QRI, and Pengana Credit Income Fund are great examples. These funds lend to property developers, infrastructure projects, and corporations, paying monthly yields between 7 to 10% PA. Often floating rate, so they move with interest rate changes. Tokenized assets and emerging alternatives. We're also seeing early adoption of tokenized real estate and income instruments via platforms like Cred Investments and Bricklet, where investors can buy fractional ownership in income-producing assets. It's early stage and higher risk, but this space is evolving fast and could become part of future hybrid portfolios once regulation matures. Now that we've covered the ingredients, let's talk about building the recipe. Your hybrid income portfolio should be diversified both by asset class and income source. Here's a practical breakdown of how you could structure it.